सबको ऐसा दिखेगा बस।
Good evening all. Today we have a webinar on the subject taxation of private trust, family trust and estate planning with the help of private trust. And today we have a speaker of Mr. Paresh Shah, who is a science graduate with chemistry as the principal subject and qualified as a chartered accountant in the year 1984, partner of KNP and Company, an international firm having presence in 10 countries, specialized in FEMA and taxation with the special focus on cross-border transaction and its taxation, investment in India, regulatory issues for foreigners and foreign direct investment, investment in abroad by resident of India, structuring overseas companies for Indian investment, advisory services on double taxation avoidance agreements, foreign collaboration and joint ventures agreement, successfully launched a unique international tax journal of a Chamber of Tax Consultants, Mumbai, and designated as the first editor of the prestigious journal, a path-breaking initiative during June 2017, first time in India. Chairman of Membership and PR Committee of the Chamber of Tax Consultants during the year 17-18, Chairman of International Tax Committee of the Chamber of Tax Consultants during the year 2013-14 and 2016-17, Vice Chairman of General Committee of Chamber of Tax Consultants during 1999-2001, member of various professional bodies including Bombay Chartered Accountants Society, All India Federation of Tax Practitioners, Chamber of Tax Consultants and International Fiscal Associations. Deliver talk at Indore in seminar conducted by the Chamber of Tax Consultants joint with the Tax Practitioner Association of Indore on Prevention of Money Laundering Act and issues in September 2007. Deliver talk at Chamber Study Circle on case studies, practical issues and FAQs on basics under FEMA during November 17. Deliver talk at Malad Chamber on overview of FEMA during November 2016. Contributed article on silent features of the trust deed in CTC Journal during 2016. Faculty for certificate course and anti-money laundering of the Institute of Chartered Accountants and all others talks on many organizations. He is also various book author and articles, just like Custom Baggage Rules and published by BCA on 23rd March 2011, co-author book of FEMA and Taxation published by AFTP, co-author a book on overseas investment published by AFTP, and so many others. So now we present a memento.
Thank you, sir.
Thank you, sir. All yours.
Good evening, members. Today's topic is taxation of private trust, which could be family trust, which could be Indian trust, or which could be offshore trust. I would like to thank Chamber for giving me opportunity to share some of my thoughts on this most sought after subject for resident Indian as well as non-resident Indian. Well, with this, let me take you through the overview of my presentation as to what is the concept of trust, whether it is a person, whether it is an arrangement. How do you look at the concept of trust? Then I'm going to take you through what are the application and uses of the trust for estate planning and how they are taxed. Those trusts could be Indian trust or a foreign trust, and depending on such whether it is an Indian or a foreign trust, there could be a different tax implications. Then we can discuss what are normal connecting tax factors where any tax system could tax the structures of a trust. And then we will look at how the onshore and offshore both are taxed in the international area. And that brings us to what is the tax provisions of the trust structures under the Indian Income Tax Act, with two case studies, and how the anti-avoidance provisions are also available in the Indian Income Tax Act, and how these trust provisions will affect and give a tax treatment under India's tax treaty with the various countries. With this, the background, let me take you to what is the concept of the trust. What do you mean by expression trust? Is it a person under the tax law, or it is something else? If you look at the Indian trust law or Indian Income Tax Act, probably that is more relevant for us because we are discussing tax issues. The section 2 into bracket 31 of the Indian Income Tax Act does not provide for trust as a person under the scheme of taxing the trust. And therefore, if you look at section 6 of the Income Tax Act, probably there is no presence of a trust as an entity being taxed as a resident or a non-resident of India. With that small brief background, let me take you to what is the meaning of the expression trust. We know that under the Indian Income Tax Act, trust is not considered as a person. Then what is its status? What is its nature? What is its characteristic? Probably, to my mind, the trust is an arrangement or a trust is a contract between the various parties. And that is how Indian trust law defines trust as an equitable obligation binding a person to deal with property over which he has a control for the benefits of the persons. The person who has a control for the benefit of the persons of whom he may himself be one, and any one of whom may enforce the obligation. What do you mean by an equitable obligation annexed to the ownership of the property? Very simple, that there is a person who owns the property, who want to settle the property either for his benefit or for the benefit of any other person under certain conditions, that such property may be utilized or may be distributed for the benefit of himself or such other person or only such other person devoid of himself. So this is what a trust law defines the trust. So coming to the understanding, what are the purposes of the such arrangement or such a trust? The purpose of the trust has evolved 400 years ago in the English feudalism system, where the king used to own all the assets. The praja, the offspring of the king, the population of the king, used to be fed by working on the properties of the king. How do you then distribute the income, or how do you feed the people out of the work they have carried out on the land belonging to the king? This is how the concept of trust has evolved in England. That the person working on the field is only an income owner of the income and not the owner of the asset. And he may be owner of the income only till he works, and then his successor, his children, may be the beneficiaries after he ceases to work for on the field or on the land belonging to the king. And then the concept has evolved, the transfer of income versus transfer of assets. So you may be able to transfer income without transfer of assets because king would never want to transfer the assets. And that is how the concept of life tenant has been evolved, that you are a life tenant of the income and not the owner of the assets. So this was the first purpose for which the trust structure has been established in England about more than 400, 500 years ago. Then looking at the structure, the various uses to which it was put to by the people for succession planning, for ownership succession. How succession planning is different than the ownership succession. Probably ownership succession includes the succession of the business also. And then it went to the modern time use for private equity investments, the venture capital investment, and other specified purposes like wealth management, the protection of the assets from the attack of the creditors. And lastly, when a tax consultant looked at the structure, probably they have used to their advantage by putting in a combination of tax related purposes and the non-tax purposes. And the depending on the tax and the non-tax purposes, the different types of trust structures emerge, and they can broadly be divided into various types of trust, which we will see a little later after looking at what are the use of trust for the estate planning, which is one of the most important objective which we are discussing today. These are like advantages in succession planning and asset distribution to the trust. That when you want to give assets in the succession, you want to put it down under various conditions as to whether you want to transfer only income during the lifetime of the beneficiaries, or you want to transfer assets, or you want to transfer assets after your death, or certain deaths in succession. All these aspects or variables can only be considered if you have enough flexibility during your lifetime. Probably, uh, therefore, will is nothing but a trust which will be operational only after death of a person who settles the either income or the assets to the estate, which operationalize or executed only after death of the person, whether the trust would come into effect immediately after it is set up during the lifetime of the settlor who is transferring the assets or the income to the benefits of the trust and eventually for the benefit of the beneficiaries which are named as beneficiaries. So these are the few advantage of using a trust structure for the estate planning, whereby you can also avoid various court processes which takes place after the death of a son. Then even gifts are challenged after the death of a person because there are challenges whether the trustees, whether the will is genuine will, whether it is signed by the settler or whether signed by the deceased, whether there are various multiple wills in the name of a deceased. All such disputes can very well be avoided by putting up a trust structure during the lifetime of the person. As I mentioned earlier, the trust can serve as a protection in case of bankruptcy by protecting assets from creditors. Claims provided the assets have been transferred 2 years prior to bankruptcy being declared. Settler can direct the managing and advisory process during the lifetime, and you can also use various foreign structure, possibly for the purpose of doing investment or doing business outside India, including the studies of the family members and settlement of family members outside India. Thus, you can look at the table where how the trust is different from the will for estate planning. There are a number of criteria and the milestones which I have summarized for today's presentation, where in so many manners the trust and will are same, but in various other aspects they are different, and that makes the trust structure interesting as compared to the will structure. So that comes to the types of the trust. This type of the trust have been designed by the people from time to time on the basis of the use at which they have been put to from time to time. Basically, there are two types of trust broadly defined as implied trust and the express trust. And the implied trust is the indirect way of transferring assets or the income, and the express is where the trust is very expressly providing that so and so will be the beneficiary. And these express trust could be the revocable as well as the irrevocable, which terms are very well known to the tax practitioners. And under both category, either revocable or irrevocable, trust could be discretionary or a non-discretionary. Non-discretionary means the beneficiaries have been named in such a trust. And further, and discretionary and non-discretionary trust could further be of a different type. Which are the main types of the trust? The trust with only life interest. As we discussed, what is the life interest? It could be hybrid, life interest as well as the inheritance. The bare trust is a one where settler, the trustee, and the beneficiary are the same person. The star trust, there are no beneficiaries, but the purpose of the star trust is to achieve certain objectives or a purpose or a project without any beneficiary being put there. You may want to create some assignments, some marriages, some projects whereby nobody else is a beneficiary, but the purpose of such a trust is to complete the project which are mentioned in the trust deed, and the project is a beneficiary, which are normally called as star trusts. Then we have a charitable trust, fixed trust, employee benefit trust, asset protection trust, accumulation and maintenance trust, which probably are self-explanatory. Therefore, I won't deal with further in those types of trust. Now that brings me to a typical structure of the trust. That there are 4 or 5 ingredients of the trust. It starts with the objective in mind of the settler, that what is his objective to create the trust, whether his objectives are in line with whether that objectives could be achieved by creating or establishing the trust within the jurisdiction where he is resident, or he want to create a trust which is not in the normal territory where the settler is resident of. So that is the normal background in which the settler proceeds with the jurisdiction of the trust. And after creating the trust, that is a contract, as we see, it is not a person, and that has a fixed predetermined objective for the benefit of the beneficiaries. And what the beneficiary will benefit is the either the transfer of income or the transfer of assets to the to the trust. And the ingredients are trustees, the beneficiaries, and settlor are the three important machineries to create the trust. In some circumstances, a settlor could probably appoint a protector for the guidance of the trustees. The concept of guidance to the trustees and protector are not found in most of the jurisdictions, uh, including the Indian Trust Law 1882 does not expressly provide for the protection or a guidance to the trustees. Normally, under the Indian Trust Act, you will find the trustees and the succession of trustees and the appointment of trustees is one of the most important objectives in the trust documents. In addition to the role of trustees, role of beneficiaries, and the role of guidance or a guide or a protector in the instrument of the trust. And as you all know, this structure is well found in the instrument of the trust, which is called trust deed, which where you will find who is the person, author of the trust, which is also called settler, which is also called grantor, who in turn transfer the assets to the trustee. So therefore, there is another party to the trust is a trustee, where grantor transfer the assets or the income to the trustees or a trustee with a condition that this is for the purpose of benefits of the beneficiaries, and these benefits are to be granted under certain conditions and under certain period of time, or it may not be given to them if certain events occur during the lifetime of the trust. So these are the important ingredients of the trust structure as well as the trust document, which is called trust deed. Thus, what do you find from the structure of the trust as well as the trust deed? That there is a dual ownership. What is the dual ownership? That the assets which are transferred to the trust are legally owned by the trustees because they have or they exercise the control and management over the possession of the properties. Whereas in effect, eventually, if conditions are fulfilled or conditions are occurring at any point of time, either with the efflux of time or certain events, then the property normally will be distributed to the people who are named as the beneficiaries in the trust deed. And therefore, although they are not the owner in the present terms, but eventually the property will go to them for the use and enjoyment of the assets which are annexed to the trustees by the owner under the obligation on the trustees to fulfill the objective of the trust as and when so occurs. So this is about the dual ownership of the tax trust sector. Then we are interested in today's discussion the taxation of the trust. As we have discussed that probably a settler would have objective in his mind which could probably lead us to discussion on the onshore trust or the offshore trust. What is the onshore trust and what is the offshore trust? When you consider the trust in the normal trust jurisdiction, where the tax neutral tax jurisdiction, not a low tax jurisdiction, then such a trust is formed in that jurisdiction is known as the onshore trust. Probably settler and beneficiaries of such trust could be either resident or can be non-resident also, or a mix of both. Whereas in case of offshore trust, as the language suggests, it is offshore. It is not on the land where you are normally residing. So it's called an offshore trust. And therefore, automatically, it brings us to the conclusion that such trusts are formed in a jurisdiction where settler and beneficiaries both are non-resident. And that brings us to the the tax laws of the onshore jurisdiction as well as the offshore jurisdiction. And both onshore and the offshore tax law relating to the trust will give rise to a cross-border transaction in terms of the income of such trust, the settlement of such trust, as well as the distribution from such trust to the number of beneficiaries which are located at different jurisdictions, and uh, that will trigger the discussion on the international tax issues, either for the onshore trust as well as for the offshore trust. Taxation of trust, onshore and offshore. This is the general provisions of the any tax system which I wanted to just put you in background of, that how the trust law or taxation in relation to the trust have been established by the leading tax systems of the world. Normally, it can be taxed at a trust level without looking at the settler or the beneficiaries, or it could be taxed in the hands of a settler, or it could be taxed in the hands of beneficiary as well as the trust both. Why and how? If you are taxing the income in the hands of a settler, probably there is no other event which can trigger the taxation of such an income, and therefore only settler is taxed. Now, if beneficiaries are taxed, probably you don't want to tax anybody else. But looking at the trust structure, it may be possible to defer taxation if beneficiaries were to pay taxes on distribution of any income or assets to such beneficiaries. And therefore, a, a mixed hybrid system has been worked out by most of the tax system in a manner that wherever during the distribution in a particular tax year, then the distribution is taxed in the hands of the beneficiaries, and the undistributed amount is taxed in the hands of the trust. And finally, when trust distributes, the undistributed tax amount beneficiary will never be taxed. But that requires a lot of records by the tax authorities as well as a trust. And therefore, India has devised a method whereby trust itself is taxed as and when the income is earned by the trust, no matter whether the income or the assets has been distributed to the beneficiaries or not. However, there are various situations under which Indian Income Tax Act taxes the trust based on the number of situation in which trust structure is designed. So let us look at the domestic tax systems and the factors and the international tax factors, and then come to the tax structures in India. As I already informed, it could be three level of taxes to tax the trust structure that we already discussed. Now, we also discussed what could be the jurisdiction of taxation for a trust. I think to answer this question, probably we need to consider whether trust is a person, or a trustee is a person, or whether a trust is person then he is a resident, or trustee is a resident, or you could be taxing directly beneficiaries on a current basis, then whether you need to consider the residential status of a beneficiaries. Then and therefore, the residential status of one of the ingredients or one of the person, like either settler or a trustee or a trust itself or a beneficiary, could trigger the taxes in the domestic tax systems. And coming to the, after discussing the general domestic tax issues, there could be number of international tax issues in case of the foreign trust or an offshore trust. What are these issues? After this issue being discussed, I think probably we can go to the trust provisions in India. Before I take you to the international tax issues, we must know what is the system of civil law or common law operating in the jurisdiction. Uh, there are various jurisdictions where civil law operates and the common law does not operate. What do I mean by common law and what do I mean by civil law? The civil law normally operates on the literal interpretation of the law without going into equity of the transaction, without going into the purpose of the transaction. They will interpret strictly the civil law, the law as laid down. And the common law is a jurisprudence evolved law whereby jurisprudence of the number of years is helpful in deciding whether a particular transaction will be taxed on the basis of tax law as well as the purposive interpretation as well as the jurisprudence based law operating in a particular jurisdiction. And therefore that brings down to the common law jurisdiction and the civil law jurisdictions. Most of the countries where the East Indian Company used to rule, including India, operates on a common law system, whereas the continental Europe operates as civil law jurisdiction. And there, the law is interpreted with the literal interpretation basis without any regard to the historical evolvement of the jurisprudence. So therefore, what it indicates so far as the impact on the taxation of the trust, you will find that the trust structure is based on the equity, the law of equity, the law of faith that the ruler and the offspring of the ruler or the members of the ruler king was in a fiduciary relationship whereby everyone thought that the equity will always operate over whatever feudalism status could be. And then that gave us a system whereby civil law will never recognize the trust law, whereas the common law will recognize the trust. And hence you will find the continental European countries will uh, have have the forced heirship rule rather than the trust or the will-based approach to the inheritance and the succession. Then that brings us to the trust structure under the international tax system as to whether the income of a trust can be considered as a pass-through to the beneficiaries, or in some circumstances, can it be considered as an income of the settler itself, or can the owner of the assets, which is trustee, to be considered as the tax unit? These questions may be answered in the Article 31A, Article 4.3 of the Double Tax Convention if the person is defined as including the trust or the beneficiary of a trust as a taxable unit. If they are not defined, it will be difficult to approach the tax treaty in these circumstances. Then the other interesting features of the international trust is that if the trust is a discretionary trust, then you all agree with me that it will be very difficult to tax the beneficiaries. And if you can't tax the beneficiaries because it is a discretionary trust as to who is the beneficiary at a what point of time, and it is the discretion of the trustees to distribute the income or the assets of the trust, then in such a case, tax system would be wise to think that the beneficiaries will not be taxed, but the trust itself is taxed at the maximum marginal rate, so that there is no leakage of taxation either today or in futuristic point of view. Now, the question arises that if you are taxing beneficiaries all the time, there is a one aspect. But if trust is taxed because of its nature as to discretionary benefits to the beneficiaries either today or in future, then whenever the distribution takes place, what will be the nature of income what the beneficiary is receiving? Whether the nature of income would be the same as and when the trust received such income. Why it is important? Because depending on the nature of income, the tax is levied. As you know, the normal income has a taxation rate of 30%. The tax rate for capital gain is 0 or 15% or 10% or 20%. And in some cases, tax rate could be as high as 40% in case of foreign companies. Therefore, the characterization of distribution to the beneficiaries is an important aspect of the trust structure, either domestically or internationally. And then there are furthermore issues as to the application of a double tax treaties. That who can be regarded as beneficiary of the income of the trust, whether it is beneficiary or it is the trustee. So, if those articles can take care of the trust structures, either beneficiary or the trust itself is a beneficiary or alienator of assets for Article 13, which on capital gains, then such issues can be resolved internationally. But there is no guidance by the OECD on any of these aspects, and most of the treaties do not consider the trust structures of the beneficiaries under those articles, and that creates a whole gamut of the new issues when we are a beneficiary, when an Indian resident is a beneficiary of the foreign trust. Let us look at what are those issues in the cross-border trust. We are not going to resolve any issues on cross-border taxation, but I'm just trying to impress upon what are those issues involved, which could be domestic issues too. These issues are अभी गरम so in the international, this S1, S2, S3 is the location of the assets, which are in 3 states, 3 countries, and there are 3 trustees who are also located in 3 different countries, not necessarily where the assets are located. And the beneficiaries could be located in multiple countries, B1, B2, B3. So in these cases, how do you determine the residency status of either trustee or that of beneficiary? And then how do you tax such income? As I told you earlier, there is no guidance by the OECD on such aspects. There is an issue has to be resolved by the domestic tax law of the country concerned and the tax treaty presents the consent tax treaties with the other countries. The issue as to why there is no guidance on the aspects of double tax treaty and the resolution as to how the income is taxed and in whose hands taxed. This is purely because to whom you attribute the income. If there are distribution, yes, you have no doubt as to attribution of income is on the beneficiaries. However, if the trust is a discretionary trust and there is no distribution, then the attribution comes to the trustee itself and not to the beneficiaries. And therefore, depending on the type of the trust, the attribution has to be defined. And type of the trust operates differently in the different jurisdiction, which gives rise to a conflict of attribution on the double tax avoidance agreements. Conflict of attribution of the income on a particular person and whether such person is entitled to tax benefit. These are the two aspects which needs to be resolved on an international basis. I've just given one small example how Australia, Papua New Guinea DTA has been resolving this issue, but that's not important much. And therefore, we go to the trust under the Income Tax Act 1967, which we are most interested to discuss about. For the purpose of completion of this subject, I have covered almost all the aspects of the trust, whether it is a private trust or a public trust, whether it is AOP or whether it is trust, in the entire discussion from slide 21 onwards. As you all know about the public charitable trust, I need not discuss because today's topic is private trust. Most debated subject by the practitioner in this area is whether trust is an AOP. Right from 1960, Supreme Court in 39 ITR 546 has extensively discussed that what is the nature of the trust, whether it is an AOP. Supreme Court said, no, it is not an AOP, because the simple reason that there are various attributes of AOP which are not found in the trust structures, and therefore it is not an AOP. What are those attributes? The very simple and the prominent attributes of an AOP is whether there is an attempt by the beneficiaries to come together for some purposes. So in the AOP, all of the members normally come together to achieve certain purpose, maybe of a profit or not of a profit. Here in the trust, they have not voluntarily collected together. It is the wish of settler and the object of the trust deed, whereby they have come to collect together forcibly and not by their own will, and therefore Supreme Court decided in Indira Balkrishnan case, which is followed consistently. Therefore, I am not given any recent decision on the subject. Now let us look at why AOP is so important while we discuss the subject of the trust. At number of places, either it is a charitable trust, or it is a private trust, or it is a discretionary trust, or it is a discretionary trust with a business income or a non-business income, there are number of tax rates are prescribed, and some of the prominent tax rates are three. Number one, very simpliciter, the plain vanilla tax. If there is no string attached as to the indeterminate beneficiary, or there is no business income, that means a trust has a definite beneficiaries without any business income, then in such a case, plain vanilla tax rate applies. What is that plain tax rate? It is nothing but the trustee are responsible for payment of taxes which the beneficiary would have paid if such income has accrued to the beneficiaries. That means an arithmetical calculation of the tax liability of each beneficiaries will have to be taken, and that arithmetic sum will be payable by the trustees. That's the plain vanilla tax rate, whereby if there are all individual beneficiaries, each one will get a benefit of the threshold, which is 2.5 lakh or whatever we are increasing from time to time, and they will also get a benefit of scheduler rate, that up to 5 lakhs this tax rate, up to 10 lakhs this tax rate, and so forth. So therefore, that brings us to the next complication, what is the next tax rate? The next tax rate is the rate which is applicable to the AOP will be paid by the trust. Why that was necessary? Very simple. When the beneficial right of a beneficiary is not determinate, how do I compute my tax liability? Can I give any threshold limit of all the 5 together and then tax it to them? Answer is no, which is not harmonious construction of the law. And therefore, the law said very simple: pay taxes at the AOP rate. No difficulties, because the tax rate applicable to all the beneficiaries will be applied. However, they will not get a threshold limit for number of times as the number of beneficiaries are. That's the logic for indeterminate beneficiaries. Then lastly, whether such a trust has a business income. If such a trust has a business income, the law says, basically law does not favor the business income under a trust, because you could have done business income very well devoid of the trust. However, law says, okay, fine. If you want to do business under the trust structure, then you pay taxes at the maximum marginal rate, not even AOP rate. Because AOP, you get the threshold, you get a scheduler system, and etc. Because AOP and the individual tax rates are the same. But maximum marginal means highest tax rate will apply from the rupee 1. So therefore, we have prominently, largely, three different taxes applicable to the trust structures. I think this is the complications probably in whole of the trust law and the taxation of the trust when you read a different provisions from either section 11, either section 12, or section 13, or therefore section 60 to 63, or section 160 to 164, or 167b. For that reason, if you just summarize the entire situation, then three rates emerges, and these are the logical way in which the Indian Income Tax Act have considered these rates as the applicable rates to the trust. Then the connecting factor in the Income Tax Act, as we discussed, that section 2 into bracket 31 does not define person as a trust. That means person excludes trust as an entity, and therefore there is no question of any residential status being attributed to the trust. And therefore you find a provision of section 160 where trustees are considered as a representative assessee for the beneficiaries which are named as beneficiaries in the trust deed. And therefore we can say that Indian income tax law provides for there is some problem. Yeah. Okay. Yes. And law provides for the taxation of the beneficiaries. How to tax the beneficiaries who are the named in the trust deed. Of course, the basic and basic benchmark for taxing any person in India is a residential test and scope of income as provided in section 5. So, if the beneficiaries are resident of India, they will be taxed definitely, no matter whether the trust is on offshore. And the second is whether the scope of income, the charging section, applies to such income. Very simple, the two conditions, which the representative trustee will apply for the purpose of computation of tax liability of the resident beneficiaries or non-resident beneficiaries for that reason. Because if we represent non-resident beneficiaries, either on Indian trust or trust, probably income may be taxed on the basis of the receipt in India if a trustee is a resident in India. So we will look at various possibilities of taxing the beneficiaries who are either a resident beneficiaries or a non-resident beneficiaries on either a Indian trust or a foreign trust. Is that something confusing or clear? Clear. Yeah, thank you. So that brings us to relevant provisions 2 into 15, of course, not concerned with the charitable objective today. Section 11 and 13 also we are not concerned today because that talks about the charitable of the trust. And section 60 to 63 is definitely we are concerned, where we are talking of revocable trust and its tax liability. It's very simple. Rather than going into the entire provision of section 60 to 63, it suffices to say that if settler has reserved the rights on transfer of the asset, then such a trust will be taxed as a revocable trust, and settler will be taxed on the income arising out of such assets, whether such asset has been transferred or not to the revocable trust. Settler himself will be taxed because his intention is not an irrevocable transfer. His intention to revoke the trust at any point of time. And then there are various situations whether the trust was a transfer of income only, the trust was with the transfer of assets, or the trust was formed with an irrevocable transfer for the limited period, and then right were to accrue to the trustees for revocation. So it's very simple, probably most simplest, that in case of revocable trust, the settler himself, the author, the trust himself will be taxed on whatever income arising through some trust. Therefore, there is no importance of trustee, there is no importance of discretionary or non-discretionary, there is no importance of whether the business income or not. So therefore, that brings us to the relevant provision of 139(1), 4A to 139 4F, 139 5, 139 8, relating to the tax return. Why this is important is 139(1), probably proviso 4, says that a person who holds the assets as a beneficial owner or who is a beneficiary of such asset will file his tax return of a profit or loss arising during the previous year as per the provisions of section 139. They also define what is beneficial owner and what is beneficiary, and therefore section 139 become 139(1) fourth proviso, and section, of course, section 139(4) it talks about charitable trust, but 139(1) proviso is very important in relation to the assets located outside India, and person is a either holds the assets as a beneficial owner or is a beneficiary in the asset directly or indirectly. So terms are also defined. We look at it differently when we come to the taxation of the trust. And of course, self-assessment tax. Of course, section 139A(11) and 3 talks about that the provision of permanent account number will apply to such trust. So they are supposed to obtain the permanent account number. And then we come to the provisions of tax liability and how this tax liability is computed under section 160 to 167 in case of the private trust, whether discretionary or non-discretionary, with business or without business income. And lastly, how the taxation of ATP is carried out. Look at the basic provisions of the law as to the residence status and the scope of the taxable income, because these are the two connecting factors which will bring us to whether under what circumstances the beneficiaries can be taxed, because the section 160 talks about the taxation of the beneficiaries in the hands of the trust, either in one or another, depending on whether it is a determinate trust or the non-determinate trust. Look at the residential status. A Hindu undivided family from or other association is said to be resident in India in any previous year in every case, except where during that year the control and management of its affairs is situated wholly outside India. Can therefore we say that other association of person is a trust? Other association of persons is a trust? Answer is no, because section 2 into bracket 31 does not include any association of persons or persons itself as a trust. The trust is excluded from the definition of person itself. So other association of person will never include trust. Let's say there can be an association of trust, private company, firm, and etc. So whether of such persons will include trust? Answer is no, because definition of definition under section 2 into bracket 31 does not include trust as a person. Then we go to section 6(4). Every other person is said to be India. Can it be included in every other person? Answer is still no, because 2 into bracket 1 does not consider entity at all. Then we come to the accessibility of public trust. I will not discuss the public trust so much, except one point which is also all of us when we discuss section 164 on the liability of the trustees and the beneficiaries to pay taxes under certain circumstances. The exemption under section 11 and 12 were not available to such trust. Then what happens? Whether such trust will be treated as a private trust or they are treated differently. So that also we will look at. Only limited point of such aspect we will look at, because people still think about that 11 and 12 exemption is not there. Then what happens? Because the simple reason that there are no beneficiaries, determinate or indeterminate. Public at large is the beneficiaries. So how do you interpret such a situation? In such a situation can be grappled with within the scheme of section 164. Whether such situation can be incorporated and solution be found by reading section 164. That's the issue at core, which will be taking in a limited way so far as the income of such trust is concerned, where section 11 and 12, section 11 exemption is not available. Section 13 says the benefit of section 11 and 12 is not available in these situations. And this is how public trust is taxed. Hence you see the tax rate is AOP rate, AOP rate, AOP rate, AOP rate, AOP rate. And in the situation 13(1)(c) and 13(1)(b), when the payments are made to specified persons who are trustees and other related parties, the tax rate is MMR. The MMR is also provided in such cases, in cases of even the public charitable trust. Anonymous donation, 15BBC, the tax rate is again MMR, more or less 30% is MMR. So this is about the taxability of public trust. Then we go to taxability of private trust. Again, as I discussed earlier, this could be bifurcated in the two different buckets. The one bucket where the shares of the beneficiaries are determinate, and another bucket where shares of beneficiaries are indeterminate. We discussed about the logic why these two classes have to be separate, because in the second bucket where beneficiaries percentage or the shares of the beneficiaries are not known, it will not be possible for any tax system to compute taxation in the hands of the beneficiaries. And the basic provisions of the law is provided in the 160 into bracket 1(4) that in case of a private trust, the liability of the trustees is nothing but the liability which beneficiaries would have paid as a whole. So, in case of an indeterminate trust, such a liability cannot be computed, and therefore a separate provision has been made out for the purposes of the taxation of the trusts where the beneficiaries are indeterminate. Very simply said, if you see number 1 is a plain vanilla tax rate, where threshold is available to each beneficiaries. Column 1. Number 2, in the same where beneficiaries or shares are determinable, but business income is there, then you will pay maximum marginal rate. If you see number 4, column 4, in column 4 is same, second and 4 is same, because wherever business income is there, whether the share is determinate or not determinate, you pay tax at the maximum marginal rate. And in 1 and 3, the difference is in the first column, the threshold is available to each beneficiaries, whereas in column 3, threshold is available at a trust level. The 10 beneficiary is lose the 9 threshold, 9 into the threshold limit. That's the only difference in the tax rates of this 4 types of trust. Is that clear to all of you? So that brings us to the taxability of private trust. This is nothing but the textual representation of what we have discussed in the columnar form of tax rates. There are certain exemption to the types of a trust where either business income is included or where even if the shares are indeterminate, some exemptions are. Those exemptions are in the line that if the business has started before in the non-testamentary will, which is not a will, but the business was on and the beneficiary was not specified. Rates, the shares of the beneficiary were not specified for the simple reason that they will benefit for the support and maintenance in future. And that was the only trust for those beneficiaries by the settler, who was a person on whom this beneficiary would depend on for the support and maintenance if he is not there. So such trusts are exempt from the maximum margin, etc. There the normal tax rate will apply. So therefore, that we can read. Probably there may not be any discussion required on that subject, because those exemptions are available here on the slide 28, 29, and 30. Now we into the small issue which we have discussed, that taxation of a charitable trust not registered under section 12A is dealt with 164.2. That income is taxed at a rate applicable to AOP and not MMR. So if we see a lot of such situation in the real time, that you have started a charitable trust, but you have not applied for 12A exemptions. So in such case, the benefit of section 11 is not available to you. 11 benefit is not available to you for 10 years. In 11th year, you apply for the registration. So what should happen to this trust? What should happen to the treatment of the returns already filed in past 10 years? So there says that tax rate of the AOP will apply to such trusts where exemptions were not available in the past. In some circumstances, exemption may be granted with retrospective effect. But the law says if that is not given, then the exemption will be given to you from the first day of the next financial year when the application is made in the previous financial year. Therefore, that is also kept at rest. Only MMR applies in a particular situation of the charitable and religious trust where the benefits were given to the specified persons. Then in such cases, MMR will apply to the extent of such income. Otherwise, AOP tax rate will continue to apply to such religious and public charitable trust. These are the small provisions which touch upon the private trust. So I thought I will just reproduce those, section 47 and section 40. Whether that the settlement, any transfer of a capital asset under a gift or an irrevocable trust will not be treated as a transfer. So there won't be any capital gains tax. That's what I wanted, because that is the first action in the life cycle of the trust, that the settlement takes place by the settler to the trustees of their asset for the beneficiaries. There are 3 important events that takes place in the life cycle of the trust so far as the taxation is concerned. What is those 3 events in the life cycle of the trust? First is the settlement, The second is the accrual of income to the trustees. And third is the distribution of the income to the beneficiaries. So thereafter, our job is to look at what happens to these three situations after considering the provisions of the law as to how this provision applies to the beneficiaries and the trust at large. And then we see three events in the life cycle of the trust that is being incorporated or that is being grappled by the scheme of section 161 and section 164. So let us look at those provisions. And we have already discussed the revocable and irrevocable transfer, that in case of a revocable transfer of the assets or the income, the tax will be paid by the settler himself on out of that asset or out of the trust. That brings us to the two important events, settlement of the trust and the distribution from trust, and section 56. Whether distribution from trust be regarded as transfer within the meaning of section 56(2), that means gift in the meaning of section 56, is an issue. So another issue is related issues. The transfer of assets by the settler to the trustee also regarded it covered by 56(2). Chief of section 56(2). Because you already have a exemption from gains. What about 56(2)? So in both the situation, whether the 56, very old decision of House of Lords in case of side and another versus Commissioner of Income Tax, cited at 1967. UK House of Lords 6, 13 December 1967. It says both the situation can be viewed differently. The situation of distribution from trust, if you consider, then whether the distribution is without consideration, answer is maybe found from the trust deed itself. That a trust was given the property with an annex obligation that on such and such event being happening, you will distribute this or you will not distribute this. And in certain circumstances, you have a discretion as to the amount of distribution and as to the distribution to be made to a particular beneficiaries. So, what was it then? The court said that it was a pre-existing obligation on the trustee, which made a distribution compulsory. Therefore, it was not devoid of the consideration. There was consideration. The consideration is a different aspect. But the distribution is from the trustee to the beneficiaries, whether it was without consideration. The question is, answer is no. It was with consideration, and therefore that cannot be a gift transaction. Section 56 can be treated. The next question is whether at the time of settlement, whether 56(2) can be considered. Whether it is a plain gift or whether it is a conditional gift. If at all we consider that transaction gift. Another aspect of prejudice, whether the transaction is a gift or not. For a transaction to be of a gift, there has to be an existence of entities. Is a trust an entity? We already seen that trust is not a person. So can it be considered that it is a gift? On both count, answer is no. So therefore, to my mind, distribution from trust or settlement to a trust will not reflect section 56(2). Then the application trust transfer in the context of section 93, which we'll see little later. We'll take this time permits because it's a subject by itself. A study on offshore trust and taxation. I've taken onshore trust a little later because we're all expert in onshore trust. So let's first take the offshore trust and taxation. The case study is India is contemplating setting up the discretionary offshore trust in Mauritius. That means non-resident is not a resident of Mauritius because it's an offshore trust for him. Beneficiaries of the trust are resident of India, UK, and USA. Now the beneficiary is the Indian resident. Trust is also planning to incorporate companies for holding investment and earning regular income. Although the trust is resident under the law of Mauritius, its income is exempt in Mauritius because all the beneficiaries are non-Mauritius, the US, the UK, and the India. So the trust law exempts such a settlement as settle all the beneficiaries are non-resident of the country in which trust operates. Now the question is, what is the question? Participants of today's discussion are posed with following question. What is the taxability of the income in the form of interest, dividend, and capital from investment in the companies? If the trustees of the trust are resident of Mauritius, resident of UK, and resident in India. In this situation, you will examine what will be the taxation of this income. Then probably if the trustee of the trust is resident in Mauritius, what will happen? This is the typical structure where our question has been reflected in the form of chart. And let us go to tax issues in India. This is an offshore trust. One of the beneficiaries is a resident Indian. Then let us look at what is such a resident in India. The situation given is that the trustee could be resident of any of these three countries. So there are three questions. If the trustee is resident of X, what is the tax liability? Y, what is the tax liability? What is the tax liability? And we can complicate the situation further by saying that whether there was a distribution during the year or whether there was no distribution during the year to the Indian beneficiaries. We've already seen what happens at distribution. We've already seen what happens at settlement. So let us look at the holistically what happens in these situations when the residential status of the trustee is resident in India, when no distribution is made to the Indian beneficiary, and when the distribution is made to the Indian beneficiaries. We know that taxation of Indians are governed by Section 160, read with Section 4 and of the Income Tax Act. Irrespective whether the trustee is a resident in India or not, if the scope does not cover the income of such a beneficiaries to be taxed in India, then it will not be taxed. Now, if trustee is a UK resident and Indian beneficiary is the one of the beneficiary, whether the income will be taxed in India or not is a question. We say that there is no distribution, for example. Now this question we will park. And we go to US and then we go to India. In case of US also, we park this question. In case of India, let us examine the trustee is a resident of India. And such an income is received by trustee. So probably under the section 161 bracket for the liability of a representative SSC as a trustee is in receipt of income on behalf of the resident beneficiaries. Scope of income, Section 5 will cover such income. But if it is received of beneficiaries determinate, answer is yes. But if it is not determinate, how do you quantify? Because all the beneficiaries of such trust are not resident of India. So the quantification fails, the computation mechanism fails in such case. So if a computation mechanism fails, can a charge fail? That's a question to be answered. I think we have a jurisprudence on the subject. The computation mechanism fails, then charge could fail. Right? But the time is different now. No matter whether computation mechanism will work or not, the charge will survive all the events. So we need to look at this situation very carefully and advise our clients accordingly in the current circumstances. Now come to the issue of the trustees resident of UK and trustees resident of US. In these cases, a trustee has never received income in India, and probably situation is same as to the accrued income to the resident beneficiary. Again, can a foreign trustee or a non-resident trustee in US or UK apply MMR or AOP tax rate in such a situation and pay taxes on behalf of the resident beneficiaries? Far-fetched. And there probably the trustee is not resident. Safely we can take a shelter that law is not that far-fetched. And if the computation mechanism failed and the resident trustee is a non-resident or a resident of US or UK, probably you are more safer than the trustee being resident. I would not like to conclude any answer on this because we are all experts to consider what we should do in this matter. So that is the analysis of this case study probably, and I think I've just reproduced section 5, etc. to appreciate what I wanted to discuss on this case study. Analysis of case study 1 I have just reproduced for your benefit so that you can relax and look at it whenever you want. Beneficiaries or the trustees as representative of beneficiaries. Who could be taxed in India? The Indian position is very simple, that either trustee or beneficiaries could be taxed, not both. The old decision of 269 ITR 101 Supreme Court in Kamlanini Khatau's case still holds good. Consider scope of total income under section 5 for Indian resident as well as non-resident beneficiaries in the background of 161 (4) a representative SSC. Income is received by him or entitled to receive on behalf of the beneficiaries. Computation of income for which tax is payable is the aggregate of income of the beneficiaries under a trust. No distribution is made to any of the beneficiaries either in UK or US or in India. What is the liability of trustees? We already discussed this liability. That if a distribution is made, we already discussed whether distribution is not made. The distribution is made, whether it will make a difference. Whether a distribution is not made, it will make a difference. Or distribution is made, it will make a difference. To my mind, yes. Because the income was not taxed, because the computation failed earlier. Section 166 of the income tax provides for taxing the beneficiaries at a later point of time when it was distributed. So probably distribution and a non-distribution where the trustee was non-resident will make a difference. We've already seen how protection mechanism works. And conclusion. Answers are given to you. You can see which are the same answers which we discussed. Now the question is, if tax is paid by the trustees who are non-resident of India, in these two alternatives where trustee could be US resident or the UK resident. The taxes will be paid by such trustees as per the jurisdiction of the either trustee or of the beneficiaries, depending on the tax law in UK and US. Let's say UK has paid taxes on the income of this trust, which is a Mauritian trust. Then what happens? At the time of distribution, when Indian beneficiary is supposed to pay tax, whether the tax credit will be available of such taxes paid by the UK trustee as and when income arose to the trust, accrued to the trust. Answer is yes and no. If you can apply tax treaty, because we have India-UK tax treaty, if there is no provision of a trust as a person, because of tax paid by a trust as a person in UK, but I know for sure that income is taxed in the hands of a trust in UK, then in such a case, trust is not a person under the India-UK tax treaty. Even if it is not a person under the India-UK tax treaty, it cannot be resident of any of the contracting states. The treaty will fail. The question arises whether the benefit of unilateral tax credit will apply. We have seen the jurisprudence. The tax treaty is in existence. Unilateral tax credit does not apply. So probably that is a difficulty in this case. And the tax treaty. Provision of Section 93 of the ITA Act. See, is very peculiarly worded. Section 93. What it says in a nutshell: if there is any transfer of the asset to the non-resident, by whom transfer? Not specified. If there is a transfer of asset to a non-resident, either it is transferred by a resident or non-resident, not defined or not said. And if such asset is being enjoyed by the resident, then such resident will be taxed in such cases. Now, there could be various situations where the resident Indian XYJ or a non-resident Indian ABC have transferred the assets to the foreign trust for the benefits of whomsoever. But income or the benefit were enjoyed by the resident Indian. Then whoever has transferred the assets to the trust, the income from such trust is sure to be taxed under Section 93. What it says is, if such income were taxable, if it is earned by a resident Indian, then such income should be taxed by the provision of Section 93. Otherwise, it will go out of the tax net. So the real situation arises when a non-resident settles a trust on himself and he enjoys the assets while he is a non-resident. And the next year he becomes resident and he still enjoys the assets. Transfer of assets by anybody, resident is enjoyment of the assets, and such income should be taxed in India by virtue of Section 93. So therefore, but there is some silver lining. Section 93 do provide for bona fide transactions. Therefore, you need to establish what are the bona fides in these cases, and whether a resident Indian transfer the assets for the benefit of another resident Indian to camouflage the taxation of the overseas trust. So in those cases, Section 93 will squarely apply, and you'll be careful about the provision of Section 93. The conclusion and the issues. That is trust a person we already discussed. Trust and Article 4(1) of the tax treaty, whether trust is a resident and then only tax treaty will apply. Whether if the 4(1) applies, Article 1 applies, the definition of a person and definition of resident both applies. Whether Article 10, 11, 12, a beneficial owner could be construed as the resident or the trust. If it is considered as trust, it will be very difficult to apply the computation mechanism in India. because beneficiaries are generally taxed in India and not the trust, unless the structure of a trust is similar to the indeterminate trust, discretionary trust. Similar provisions are for the alienator in case of capital gains under Article 13 of the India Tax Treaty, whether the alienator is a trust or the beneficiaries. Permanent establishment of trust, whether permanent establishment is of a trust or the beneficiaries. And if the beneficiaries are situated in number of states, whether for the same type of income, the tax treaty with respect to India will apply with respect to each resident beneficiary in different states, or the jurisdiction of trust will access the tax treaty. That's a question before us. Then once we determine these issues, we have a ITA, Income Tax Act issues about the characterization of income or the attribution of the income. The attribution is already discussed. What will be the characterization of such income? Because the characterization is lost over a period of time when a distribution takes place. So that is also an issue. No OECD guidelines, and commentary by leading authors has a report on the transparent entity and how do you attribute that tax, attribute the income to the transparent entity, and how do you apply the tax treaty by virtue of extending the tax treaty to the beneficiaries in the respective states with India. So that's the brief about the issues and the conclusions. In the recent trend affecting offshore trust, we all know what is happening at the FTTR division and the India's tax related information exchange treaties. The mutual exchange of information and transparency related issues are very much in the radar of G20 and most of the countries in the world, and therefore entire whatever type of structures, whether transparent or non-transparent, will be always available to the tax authorities in India, and therefore one has to be careful in in aggressive tax planning by trust structures. It is only a non-tax purposes which will lead to the culmination of trust structure, and not the tax aspect as a main objective of formation of the trust. And I've also given an example of one of the tax-related exchange, information exchange treaty with Bahamas. It says that limitation on exchange of information and the circumstances in which the exchange of information can be short and should be given by the country with whom the tax information exchange agreement has been signed. I don't want to take it too far to discuss these issues, but we all know that these are the issues to be considered while discussing the offshore trust or the trust or the formation of the foreign trust. And then lastly, the section 94A, when the information are not exchanged by the countries, the government of the other country has a right to suspend the tax treaties under section 94A. India has exercised this provision by suspending the tax treaty between India and Cyprus for some time, which is now restored. Thank you very much, ladies and gentlemen, for patient hearing.
Questions?
If you have any questions, please type.
If they have any questions, they should.
Okay, they should type, no?
You just say that.
Just say.
Okay, where is that? But
No, you say.
You say.
okay. Okay, if you have any questions, please type it on your laptop, so that we can answer in next 20 minutes, which we have. Thank you so much.
There is a two questions. First is from Mr. Amitabh Singh. Under section 164(1) for an
Indeterminate trust.
Yeah. Will MMR also apply on income that are taxed at special rates like long-term capital gains?
MMR will apply on all types of income. This trust is indeterminate trust. There are two tax rates. One is the AOP related tax rate, where no other normal or an abnormal tax rate will apply, and in another aspect where the business income is included, and in such a case MMR will apply. Next question, please. It's it there.
Can a public charitable trust be converted to a private trust? It is from Akul Agarwal.
Yes, it can be converted into private trust. The prominent example is Escort Hospital.
We wait for 5 minutes.
Yeah. So we will wait for some more time to create questions for us.
So it's from Mr. Pratik Shah. If settler is one of the beneficiary, will the trust be treated as revocable trust?
No, if it's only beneficiary, then it would be treated as a bad trust, and probably it may be regarded as a sham trust and not the revocable trust.
No question.
Let it come.
This was one of the.
So, this is from Mr. Akul Agarwal. As you stated in the case of Escort Hospital, in which the public trust was converted to private trust, that is the guidelines/law for the same.
The guideline is very simple. See, all your voluntary contributions and income have been exempt from taxes from time to time. So any of the assets are created by virtue of such exemption on it becoming a private trust. What happens to such exemption is the question you have to answer. I do not want to give that answer now because we do not want to disturb others for this simple and complicated question. But this is what you have to answer, and the provisions are found in section 11, 12, and 13 for the purpose of such a conversion.
The next question is from Mr. Chintan Gajal. What would be the tax status of the private discretionary trust wherein one of the beneficiaries is the non-individuals? This question arises as there are ruling holding that if all the beneficiaries are individuals, status of a PDT, will that be of an individual?
No, there is no requirement of a status of a trust being created as a individual or entity or a private company or any other entity. What it says that in such a case, the tax rate of AOP will apply or individual will apply. You don't require to determine the entity or a status of a trust, either individuals or otherwise. What it says is trust will be taxed like this. It doesn't say that we are individuals on AOP, because we already said that trust is not an AOP.
The next question is from Mr. Sagar Tilak. If transfer to irrevocable trust is not transfer under section 47(3), then does it mean that transfer to revocable trust is a transfer and will be taxed as a capital gain? As transfer to revocable trust is not a transfer, shall we presume that transfer to revocable trust is transfer?
Yes, you can consider that it's a transfer.
The next is from Mr. Pratik Shah. How the distribution received by an Indian resident from a foreign trust be taxed in India? Will income retain its original character?
See, so far as the Indian beneficiaries are concerned, the tax rates are provided irrespective of the nature of the income. So therefore, the nature of income is not important so far as the Indian beneficiaries are to be taxed. Unless a trust is a specific trust where you will be taxed in a like manner and in the likes liability as the beneficiary would have been taxed. In such cases, the nature of income will be important. The column 1 of the chart. on one of the chart.
And is from Mr. Sagar V. What shall be the type of SST while applying for PAN of a family trust, which is a private trust? It's not a trust under Income Tax Act, hence we cannot select it as trust, and it's not AOP. What is the correct type of SST?
Individual, because trustee is applying. Because trustee is applying.
Can
And there is a probably and availability of a option whether you are applying for as a representative SSE. Answer is yes, and therefore it takes care of both.
This from Mr. Mitesh. Can one of the trustees or beneficiaries of a private trust be settler?
Yes, it can be settler.
This is from Ms. Nancy Cheda. For chargeability of a gift under section 56(2), you mentioned that since trust is not a person, the computation mechanism fails, and therefore such receipt will not be taxable. Reliance placed on 1967 British decision. Is this understanding correct? If yes, will it not extend to any other income as well?
We are talking of transfer of asset to the trustee by the settler. So we are saying that the transfer of asset by the settler to the trustee is not a gift. And similarly, we are saying that distribution is also not a gift. So it will apply to the asset and the distribution of the income, but it will not apply to the transfer of income by the settler to the trust. What we are saying is transfer of assets by the settler to the trustees. Income is to be transferred, then of course you are not transferring asset, but you are transferring only income. In such case, if it is an irrevocable trust, income amount is nothing but the asset.
Next is from Mr. Chintan. Following your reply, what tax rate shall apply to a private discretionary trust having one of the beneficiary as non-individual?
See, the tax rate applicable are 3 rates. In case of indeterminate beneficiaries, in case of non-determinate beneficiaries. Now, whether if the determinate or indeterminate, the beneficiary is either individual or otherwise, whether the tax rate will differ. Answer is very simple. If you are falling in column 1, in the like manner as the beneficiaries would be taxed. So if a private limited company is a beneficiaries, then the tax will be paid by the trustees as if the private limited company would pay the taxes. And rest of the column you can definitely answer.
The next question is from Mr. Pratik. What will be the cost of acquisition in the hands of the beneficiaries in respect of assets received as distribution from the trust?
Cost of the asset will always be the previous owner, as mentioned in some of the provisions of section 49 or 43. But I don't want to answer you now because I cannot lay my hand on such provision as of now, but definitely will answer you a little later. We can always take good time.
That's it.
Okay, now we have questions from the participant present here, the learned Ashok Bhai. The question is, the will has been made by past gentleman, and will says that the there will be a trust formed, and the trustee will be my solicitor for the benefit of modern art. Now, there is no beneficiary who are named, and this is a purpose trust. Therefore, There's a purpose trust, therefore. There is no distribution to anyone who is individual or a person who will be taxed under 231 vis-a-vis resident vis-a-vis scope of total income under section 5. So it comes to a question whether a trust is a charitable trust or it is a private trust without any beneficiaries. That's a question to be answered. If you answer the question that it is a modern art for the larger public utility, then whether you could obtain section 11 benefit by applying the under section 12A and get the exemption, or if it is not, if you're not getting an exemption because it is not in the interest of the general public at large, then probably it is a private trust with no benefits, and the trustee will be taxed therefore at probably an individual and AOP rate as an AOP. That's what my view is. So second question which Sharmaji has asked, section 56 at the time of settlement of trust, if settler settles the trust for the benefit of a defined relatives, can you say it is not liable to tax? Yes, it is not liable to tax at the time of settlement because it is not a gift under section 56(2) as we discussed earlier. It is a settlement, it is a contract whereby the property is put into the contract, and on certain events occurring, then only distribution can be made. Only thing is the silver line is the protection which is afforded by your question is, if they happen to be 56(2) exemption relative, then there won't be any incentive for the tax officer to do anything in this case. That's what I wanted to say. Thank you, Ashok. Thank you very much, friends, for interesting questions, and we conclude this session by answering the last question of Ashok Bhai. Thank you very much.
I'll just give a vote of thanks. Friends, you will all agree, Paresh Bhai has given a detailed presentation and a fantastic delivery of the presentation. I, on behalf of the chamber, thank him for accepting this particular invitation and giving such a wonderful presentation. Thank you very much. Yes.